And the project returns are 1.9x equity multiple. What that basically means is that for every dollar you give us over the course of the holding period, right, which we projected is up to 5 years, we'll give you $1.90 back. So so $1.90 back. Essentially what this means is that if you include all the cash on cash returns, plus the returns that you'll make on exit, which is upon sale, 1.9x is a multiple. So for every $1 you give us, you get $1.90 back.
Which includes your original dollar.
Which includes your original dollar, obviously, right? Skin in the game, basically, guys, is very important because essentially, for the lack of a better term, you don't want to be involved with people who don't invest any of their own money, because the issue there becomes that it's a case of heads I win, tails you lose. Heads I win in the sense that if this property performs well, you think I'm a genius, I definitely think I'm a genius, and everybody is really happy. But you've got to realize what happens if the property doesn't perform. So the sponsor's got to feel some level of pain, right? So they don't just check out if the property isn't performing. So we put in $300,000 from our own pockets just to show you, our interests are aligned with the investors. On the loans aspect of things, we've got a bridge loan. There's a couple of reasons for that, but the biggest reason from my side at least is that if we're going to dispose of this property or at least refinance or finish the value add process within 2 years' time, getting an agency loan is completely asinine. I mean, and the reason why it's asinine is—
Can you say that here?
Sorry, what? Asinine, right? Yeah, it's not a bad word. It's more than once. It's more than one syllable.
Yeah, as long as you don't cut the word in half.
Okay,
Yeah.
all right.
Yeah, I mean, as long as generally you don't cut the word enough. Look, it's and I'm going to say asinine again. It's asinine because we're going to do all this hard work, right? So we increase the NOI, we've done all these renovations, but if you've got an agency loan, and then you want to go, say, in 2 or 3 years' time to either sell it or refinance it, you get charged massive prepayment penalties. Right?
So just an agency loan in this case, for some of you that may not be as familiar with the term, we're talking about Freddie Mac, Fannie Mae type debt that tends to be a 10-year, it can be a 7-year, but the average is 10-year. It can be as long as a 12-year. And by locking in those long terms, they will give you those, always lower interest rates. And in today's terms, the interest rates are just astounding that are being offered by Fannie and Freddie. However, that's like a black widow laying their trap, because if you're trying to do value add, as Omar is describing, it does not work for you. So just had to throw that in there to expand on agency.
Yeah, but look, the flip side to this is, if you're, for instance, buying a property by yourself, as in you and your family is buying the property, so there is no external pressures, you want to hold on to this property for, pass on to your kids and something, then by all means go ahead and get an agency loan, because you're going to be in this for the long haul. But contrary to what pretty much any sponsor, any multifamily sponsor will tell you, we all make our money upon sale. Essentially, we make like 80 to 90% of our money upon sale. So so what's actually going to happen on the ground is that a sponsor is going to do all this hard work, and then they want to sell and get the money. So if they force you to get into an agency debt, the problem is going to be all the prepayment penalty or the penalty that the lender charges you. That's not coming out of the sponsor's pocket. That's coming out of your pocket
that comes out of the profit. Yeah.
Yeah. So you will be affected. The sponsor will not be affected. So just some things to keep in mind. The loan, by the way, over here, the interest rate, which it says 4.8%, we were really conservative on it.
Yeah.
Actually, the interest rate we ended up getting was 4.51%, actually.
Yikes.
So,
wow.
I mean, to be honest with you guys, that's like somebody giving you free money.
That's ridiculous.
What if the market turns too? So can you?
So what happens? So what
happens when the market turns? Yeah. So what happens when the market turns? So what happens if we do go into recession? What happens to interest rates? Do they go up or do they go down?
Take a wild guess, guys. Because I've literally
down. Everyone's saying down.
They go down. So what is our risk in the next 3 to 4 year time frame of interest rates going up? Very low.
Relatively speaking, right? It's a probability game. Nobody knows.
It's a probability game. Exactly. So if many people are saying, hey, there's a recession coming, well, that doesn't mean, why would we want to lock into agency debt at current interest rates then and try and, sometimes you lock into agency debt, you say, well, somebody will assume it. I'm going to sell it to somebody else. They'll just assume my loan. No one's going to want to assume a loan that's, you know, half a point higher than what they can get.
Oh, actually,
So,
this is happening right now. I'm looking
yeah,
at a few deals in Atlanta,
yeah,
and some of the problems are that there are guys who want to sell their assets. They want whoever's buying to assume the debt, and that debt is at 4.8%. Now, look, I'm going to be honest with you. 4.8% in any other time in mankind's history on these types of assets would be considered a steal.
yeah,
But
absolutely.
I mean, I was like, dude, like, help me out here. I literally got a loan like 2 weeks ago, and that's 30 basis points lower than this. And I don't even have to go through all this paperwork of assuming and doing this and that. So just keep that in mind, because a lot of times people are concerned and say, well, I'm concerned about a recession and interest rates going up. I was like, dude, you can only have one or the other.
Yeah, it's not going to
Because
happen.
if it's a
both.
recession, the Fed isn't going to dig a deeper hole. And look, if it's a boom time, you're not going to have a problem selling the property. Okay. It's not, that's not going to be your problem.
Yeah.
So just giving you some context around, you know, when people, a lot of times people hear things and we repeat things without necessarily realizing that they don't necessarily make sense. And when you step back and actually think about it, then you actually realize, oh, a lot of things that people assume are common sense are neither common and they're nonsensical.
Just to give you an eyeball full of what the projected returns are. These are cash on cash returns. So there's an 8 pref for this. So the investors are getting an 8% preferred return. So they've got 8% year 1, year 2, year 3, it starts to go up where they've got 9.3%. And then notice it goes down here. So that's a bit funny, right? What's happening here? Well, what's happened is this is year 3, and our bridge loan, should we keep it past here, the interest rates have changed. So we've gone through 3 years of the bridge loan, and then this is the extension, correct, Omar?
Yeah, and this is actually where the interest only period goes away.
Yes,
right?
so the
now we're
interest
paying
only, so
mortgage
it's both.
amortization.
So the interest only period goes away, and we're going into an extension of a 1-year loan and then an extension of a 1-year loan. So that's why we have this switch. But you can see it's, I mean, all in all, that's not an extremely dramatic change. I mean, it's almost a point, but it's less than I'm used to seeing, actually, the difference between when IO stops.
Yeah, and guys, by the way, this is just on that point about the bridge and how quickly all syndicators, including ourselves, want to get out. You got to realize our business plan, you see how by business plan, I mean the renovation plan was between 18 months to say maybe 2 years at most, right? So after this, around say the 16, 18 month mark, if you're actually executing on your business plan, most syndicators have their hair on fire, either trying to refinance a property or to sell it because they've done the bulk of the heavy lifting. Right. So when they sell it to somebody, the idea is that that person is looking more for a turnkey solution, a stabilized property. Whereas we, for instance, have to spend hours and hours and hours every week making sure that we don't leave any rock unturned. Right. So it's a different type of buyer, buying a different type of property. But that's why you see, because we're trying to get out in 2 or 3 years, this gives us a lot of ample room. This gives us a lot of runway in case we're not able to execute on a business plan. We still got 3 years to go do something.
And
can you explain the extensions, the 2 extra years? Can you explain that a little bit?
So Omar, here's the loan information again, just to talk about the 3 years plus 1 year plus 1 year.
So basically, guys, over here, what basically happens is that because it's a 3 + 1 + 1, the +1 + 1, what it really means is that we have to hit certain objectives or certain, say, key metrics that the lender actually asks us to get. So for instance, on this, I think we have to hit a 7% debt yield when we're trying to do the first extension, which is years 3 to 4, and an 8% debt yield from years 4 to 5. That basically means that our performance has to follow certain paths, which is really going upward trending, because otherwise the lender is not going to basically give us the extension on the loan.
Yep. So we've got to perform.
Yep. Yeah. So it's a pay for play sort of deal, right? You perform, you play. If you don't perform, you're cut out of the game. And you actually want that. You want sponsors to feel that heat, because if they don't feel the heat, look, as an example, if they don't have skin in the game, they don't feel the heat. If things work, it's all good. But if it doesn't work, they're just going to check out and then your money's gone.